Well, 1 month ago, it was the two R's, rate and rains. Suddenly, it is two C's, China and commodities. So in a very globalized and evolving world, how should one read into the current crash in Chinese stocks and the downtick in commodities? Can India really remain isolated to the meltdown in commodities and China jitters? To discuss that and to dissect that, I have a perfect guest, Neelkanth Mishra, India strategist with Credit Suisse. Neel, fantastic to have you back on ET Now. Thank you for joining us.
Good to be here.
The two R's have become the two C's, China and commodities.
The markets always surprise you, right?
How should one connect the dots here?
See, I think we've been saying for a while that the global trends will matter a lot more for the Indian economy, because now in terms of massive delta, so things are improving steadily. I think the big surprises will actually come from the world, and so what we have seen happen in EU, then we have seen China. I think the bigger concern is that China is a very large part of the global economy. Looking at how hard commodities like steel and iron ore have traded, it seems that the growth downgrade can actually be quite meaningful. If this is real, I mean, if this persists, then it can actually be. And what is also important is that the Chinese government was attempting to address their issue of high debt by inflating the equity market, and so that the debt to equity transfer could happen. But that's no longer, that doesn't seem possible, at least has been pushed out by a few months, if not quarters, which means that the Chinese growth story could take a long time to, or a while to revive. And that's very negative for global growth. So we have seen export numbers coming out of, say, Taiwan or Thailand or Malaysia, Korea, they were all disappointed. And everyone was assuming it was because of US and Europe, but it now seems that it was actually because of problems in China. And it affects us as well. It affects our markets a lot more than it affects the real economy, meaning that the listed metal stocks, the banks that have lent money to them, are a meaningful part of the stock market. What happens to the economy, of course, is that you see a deflationary pressure, which is generally a good thing.
That's China. But in the short term, do you think the sell-off in Chinese stock markets and the crash in commodities could have a domino effect, because hedge funds have lost billions and investors have lost millions? So it is going to change, or it could change the entire risk-off setup.
Not necessarily. You see, one, the Chinese market is really massive, right? And I think India sort of pales in comparison. So a small amount of inflows coming into India is actually sufficient. And I think most people realize that with oil prices falling, commodities falling, rate expectations getting, the rate hike expectation getting pushed out. The US 10-year has dropped 20 bips in the last week or so. It's actually good for India. And just about the time that green shoots are starting to become visible in India, I think I don't expect too much of a contagion effect on India, really.
But your view on India is constructive. I was scanning through some of your recent reports, and your house view and your personal view is that let's not criticize the lack in growth momentum. Growth is happening, we are not acknowledging it, we are not experiencing it.
So we are experiencing it as well. We are just not acknowledging it. I think that's the better way to put it. So see, what I like to tell people that India's economy is like sub-Saharan Africa. It is sometimes very...
Sub-Saharan is third world.
It is, but if you look at per capita GDP of most Indian states, there are states like Somalia, there are states like Kenya, so there is very basic stuff, so the issue is that people live in large metros, cities, they have great infrastructure, they have all the food they want and so on and so forth. They somehow forget that a large part of India is living without roads, living without electricity, living without phones. In fact, the recent SECC survey suggests that only 62% of rural households have a phone. It was done quite a few years back. The ASA survey says 74, but still there are 26% of rural households that don't have cell phones. There are 12% of rural households or the rural population which is living in areas which do not have all-weather road connectivity. 20-25% of Indian households don't have power connections. Half of Indian households use firewood for cooking. These are very, very scary metrics.
And that's where the opportunities are.
That's where the opportunity is well. And the good thing is, and so just because we are poor doesn't mean we'll become rich, right? So, and that growth will be high. I mean, the good thing that I see is that state after state is interpreting the May 14 election verdict as the symptom of the change, not the cause of the change, right? So every political leader has realized that what happened in May was replicated in then Maharashtra, then Haryana, then Jharkhand, then Chhattisgarh, then in Jammu Kashmir, and that in order to compete effectively, you need to deliver on electricity, on roads. And so what I have been surprised by is that West Bengal seeks universal electrification, that Odisha by 2019 seeks universal electrification, that the Lucknow-Agra expressway in UP is progressing and all land parcels have been acquired. It's been divided into 5 parts, all are proceeding very well. That at least the UP government targets to provide 16 hours of electricity. I mean, you and I can question why only 16, why not 24, but where they are compared to that 16 hours by 2017 is.
And how exactly is this different from last 3 years? So that if you can put some numbers, we can judge it by numbers.
See, so let me give you an example of Bengal itself, right? So their capital expenditure by the West Bengal government has been rising at 35% CAGR in the last 4 years, right? It's rising from a very low base, but the low base doesn't mean you get a high growth. You need intent and So state after state, what you find is that the intent has changed, right? And it has changed.
More federal powers have been allocated, more capital has been allocated, more budget has been allocated.
It is about the money, it is about the enabling characteristic of the central government, but also because it is a political imperative. Yes. People respond, politicians only respond to what people want. And with rising cell phone penetration, with rising literacy, with rising TV penetration, what is happening is that the voter is a lot more aware. I mean, you wish he was more aware. You wish the Greek voter was more aware. But the reality is that they're becoming more aware, and so they can't be taken for granted. And therefore, a lot of very positive things are happening. And state after state. I mean, it's not just the famous states of Rajasthan which are doing phenomenal things, but it's also the states that get less publicity, like Madhya Pradesh or West Bengal, that or even UP, though of course we'll have to see the delivery, but the intent is very clear and very positive.
But ultimately everything has to translate into earnings. That's what stock investors look at, that's what fund managers want. So I'm sure clients are asking you, okay, great, I'm with you. A lot of good things are happening, but we want to see that in earnings. Q1 numbers were not strong. Your own estimates for Q4 numbers were not strong. Q1 numbers will not be strong. Your estimates are not gung-ho. So how come this productivity is not translating into numbers, and which sectors will benefit if productivity leap is so strong?
Yes, so the first, and this is something that I keep emphasizing, and I think it's so important that I'll repeat it, that the market and the economy are totally different, right? So let's not assume that because the economy is doing well, the market is going to do well, right?
China.
Sections, yes.
Big example. How can we forget that?
So sections in the market will do well, right? For good or for bad, the only way in the large listed space that you can benefit from the transformation happening in the states where the state governments do work is consumption and cement, right? So these are consumption, both staples and discretionary and cement. I think are growth stories. I mean, I think there is a mistaken belief in India that which we have inherited from the West, among a lot of bad ideas that we've inherited from the West. One of them is that staples is a defensive story. It's that oh, you're so positive in India, why are you overweight staples? I say it's a growth story. These are companies that are going to deliver 20% earnings growth. Some of them are expensive, but we're not.
That's all right.
Yeah, but look at what is happening. See, what are the options left for China? See, if commodity prices keep falling, they can afford to say that the only thing they're scared about is inflation, right? So the thing they're scared more about than slower growth is inflation. So if inflation goes down because of what is happening to commodities, they can cut rates more. And the one lesson they have learned from the US and Europe is that the best way to deal with high debt is to inflate assets. So I think any place that you are seeing growth, I think PE multiples. I mean, I'm a very conservative investor myself, but I would say that if in the absence of growth anywhere else, these are stocks and sectors which will keep.
So you would advocate buying into staples even though they are expensive, but good things, they come at a price, and these companies can grow at least for the foreseeable next 2 or 3 years.
Yes, and so companies within them are very dynamic. I mean, when I go to say see companies, they're expanding distribution, they're expanding product categories, they are making kinds of innovation that I just amaze me.
And these are specific consumer staple companies who are doing innovations.
Yes.
We tend to think that a soap company or a toothpaste company cannot innovate, but they are innovating.
Yes, and these are not, we think that, oh, who else is going to use toothpaste, right? But you look at India's toothpaste consumption versus that in the developed world, there is a massive delta still left in terms of detergents.
Manal brushed once a day only.
In front of your kids, you should brush at least twice, because you learn from that. But the kind of toothpaste you use, the value of toothpaste you use, I mean, all of that actually makes a difference. I think same is private sector banks. So one sector is clearly consumer staples, discretionary, cement, and private sector banks, because I think the government has made its intent as clear as it can that the way to privatize the banking system, because there are clear inefficiencies in PSU banks, the way to privatize the banking system is to let the private sector take share. So even if the recapitalization of PSU banks happens, it will be not to encourage growth. It will be possibly to plug a hole that emerges when they...
So the big thesis for private banks is very clear, but I have a follow-up question, which is that most of the private banks have an FI limit problem. Most of the private banks either are overweight with one fund or the other fund. So isn't that a crowded trade?
It will, see, there are stocks that I have covered as a pharma analyst for 10 years, which have been consensus buys, they've always been expensive.
But that works, and growth is there.
If you are confident of growth, if it's as good, and the FII limit problem, of course, that's nothing that the viewers should really worry about,
Certainly.
But those limits have also opened up. In this last round of sell-off that happened, where macro funds were shorting India because they thought because of the rate hikes somehow India would get badly affected. So they were shorting through the Nifty, and through that all their FII holdings were falling, right? So now there is enough limits there, and generally I found that this principle of investing with that fund is overweight, and therefore so long
keep
as
it straight and simple.
Yes, if there is earnings growth and the multiples are not exorbitant, I think whoever holds it, it doesn't matter.
I may sound repetitive with this one, but just for the benefit of our viewers, in terms of mega trend, you are of the view that government productivity will increase and demand for cement, demand for road construction companies will only increase. Yes. You are of the view that one should not lose out on investing in staples just because they are expensive. That's where growth lies. Correct. And private banks is not a one-year story, but it's going to last for many years to come.
Yes, and they are out competing. See, it is still a scarce commodity. It is restricted. This is the only area now where there is a license, right? And because there is scarcity, so the companies that are incumbent, when I see a private sector bank opening a branch office in Chaibasa, right, and a billboard advertising it in Worli, who's going to give deposits to the PSU banks? Who actually
the experience of banking with a private bank, whether it's online or offline, I think is incredibly better.
And the PSU banks sometimes charge money to get the passbook updated, right? And so just the sheer service quality. So once the trust develops,
the branches are conditioned. Branches work.
Yes.
The tellers are also good-looking girls.
Well,
all the things
different people get motivated by different things, but there's also a question of trust. So so just because one new bank comes up, it doesn't mean people go and give deposits, right? But over a period of time, I think the PSU banks will struggle to raise deposits also, and it all plays into the hands of the private sector banks. So I think it's and as their net interest margins expand, they can raise more capital at a higher price. Well, they are higher than what they would have been if the PSU banks, let me rephrase that, yeah. So the better way to say it is that they are higher than they would have been if the PSU banks are not under stress. And that allows them to make better profits, that allows them to grow faster. And even if they have to raise money, they raise money at a much higher multiple. So it becomes a virtuous cycle. The only thing that I think private sector banks need to be very cautious of is the disintermediation trend that is also started, but because they're still small, so they don't need to worry about. On the corporate side, the growth of the bond market, It is still small, it is still liquid, but it is a lot less illiquid and a lot less small than it was 5 years back.
But if Reserve Bank of India keeps on mentioning that, look, I want to regulate NBFCs, can that hurt the competitive edge they have? NBFC like Bajaj Finance enjoys a NIM of 3%.
Right.
Mahindra & Mahindra Finance has a NIM which is north of 2.5% even in a depressed market. So my only fear is that Reserve Bank of India again and again has said that NBFCs and banks have a strong NIMs. They are not in line with global averages. Watch your back.
Which is fair. I mean, so for the entity which actually controls the licenses, and if you see that because you're controlling the licenses, the few people who have the license are actually profiteering. Not profiteering in the classic phrase, but are making more profits than they actually would if it was a free market.
It's efficiency.
Yeah, so it is important for them to sort of keep reminding them. But even if you launch a new bank, I mean, for it to develop that kind of system, to scale up to that level, will take a long time. And so in terms of earnings growth, some of these companies can actually grow much faster.
And new bank licenses, whether it's rural banking, whether it's mobile banking, is that a threat or it's not going to be disruptive?
No, it can be disruptive. Some of these things can be really fast, right? So, so about a year back, someone told me that more than half of Facebook users in India are rural.
Is
right?
it?
Yeah. So this is 1 year back, right?
I love your data analysis. Every time I meet you, I get to learn something new.
And these are fascinating things. And apparently, the usage picks up after 10 p.m.
The guy gets home and the girl gets home.
Yeah. So because social interactions are not frowned upon, so then they exchange. And for all you know, when these folks in 3-4 years and they can teach their parents mobile banking, so all of those things can actually grow much faster than we thought. Because who would have thought that smartphone penetration or that smartphone prices? 1.5 years back, people thought that when 4G launches happened that we would not have a sub $200 smartphone. It's now 4,000 rupees. Right?
Okay, I read a report from your house and I think that was largely authored by you. Nothing short of a scary report on the steel sector. Yeah. You've really written an obituary for the steel sector.
It is not an obituary. I mean, it is more of a message that, look, by everyone thinking about themselves, their narrow interest, you're actually hurting everyone, right? Yourself as well. So what we say, just to summarize in that report, is that, look, if there are 4 companies which together, or 3 companies which are together $20 billion in debt, right? And their interest costs are $200 plus. Some of them are $250. Chinese steel prices today are like $325, right? Just the interest cost is $250. And in the last 3 months, banks have given them 5,000 to 8,000 crores more, right? These are companies with 40,000 crores.
These are good companies. Without getting into names, these are the top 4, 5, 10 names which we are alluding to.
Yes, good, I don't know, but they are known companies, right? So they are companies with 40,000 crores of debt and 3 million tons of capacity, right? What were the banks thinking when they gave them money?
So is the problem the steel sector or the problem the banking sector? Who is in a bigger trouble?
I think the banks are in bigger trouble. So, because they are throwing good money after bad. So, in order to sort of postpone the day of reckoning, they are sort of believing that, oh, let's just push it out by 1 year. It's not changing because when the steel down cycles happen, in the last down cycle there was no demand growth for 20 years, right? So, it is not a 525 that you push it out by 5 years and things change. For the steel sector, the problem is that even the healthy guys start getting hurt, right? So what we have said in that report is that even if you raise import duties, not that the government is raising import duties, even if you raise import duties, you still cannot be helped because there is oversupply in the domestic market and the weaker hand is not going away because the banks are supporting them. What that means is that the healthy hand will become sick, right? So it hurts everyone. And unfortunately, someone had to point it out to people that, look, this is very bad for the system. Now, of course, for our investors, it means that the downside in steel equities can be massive.
But broadly, the important point here is that because of China, the metal sector, the steel sector will suffer. PSU banks, which have given a lot of money to some of these steel companies, they will not have recovery. So, it's hard for me to fathom an economy where 65% of the lending which comes via PSU banking sector is under stress. And can we really make a constructive case for growth without the support of PSU banks?
Okay, that's a very good question. That's a very commonly asked question because it's a very fundamental question. It's a deep question, right? Look at it from three perspectives. One is, as I said, there's a disintermediation going on. So if I look at, say, March to March, right? So if March 14 to March 15, if the loan growth was, say, 10%, for argument's sake, there is, if you include the higher issuance of bonds, that 10 becomes 12. You look at oil marketing companies which did not require a postponement, or rather, there were not too many under recoveries, and the government didn't have to pay anything. Last year they got paid in May. This year that was not needed. So their borrowing dipped by about 51,000 crores, right? So that's about 1% more. You're already at 13%, right? Possibly slightly more than that. If you include the fact that power sector and metal sector shouldn't be growing loans at a very massive pace,
because
right?
There's no growth.
There's no growth, there's no capex, right? So then the rest of the system is actually growing at 15-16%. Yes.
Right? Which is the good part of the system.
Which is the good part of the system, and the productivity growth and all of that is still happening. Now, from the supply side, so from who's going to provide the loans, right? So as we just discussed, if you adjust for the oil marketing companies, the steel, the metal, and the power generation companies, you only need 12-13% system loan growth, out of which 2%, maybe this year a bit more, is going to come from the bonds. You need 10% loan growth for the banks, and with private sector banks, which are 25% of the market growing at 20%, 5% of the loan growth is done, right? And there are PSU banks which have capital and which can grow. So I don't see it as what can happen, or what could have happened is if the banks were healthy, interest rates would have been maybe 50-75 basis points lower.
They could have compressed their NIMs and they could have kept the cost of deposits.
It's sheer demand supply, right? So if there is a lot of supply of deposits targeting very few investment projects, then rates come down, right? But right now that's not happening because the banks cannot afford to cut rates, the PSU banks, and therefore no one is cutting rates, right? So that I argue, but that I grant. But other than that 50 basis point of interest rate cuts, which could have triggered maybe minor growth.
Which is not great, or which is still great?
I don't think where India is, 50 basis points here or there will make a big difference to the investment story. I think the investment story will still be attractive, based on new areas. I mean, renewable energy, power transmission, railways, road ordering. Road ordering has been massive, right?
Your numbers are, your reports indicating that. I think this is the highest road construction since FY11.
The rural road construction, yes. So FY15 was 36,000 kilometers. It was 70% ahead of target. And that is the
efficient. Great data points which we don't map. And they don't add up to the GDP, but eventually when the productivity gain comes in, we get surprised.
They do add up to the GDP. When the GDP numbers come out to be higher than what people were used to,
these are the points which surprise you. This is the productivity gain.
This is what is happening, and you are not capturing it. And if you look at, I mean, I was talking to someone who's looking at the MCA 21 database in a lot of detail, and he was saying that, look, the fastest growing segments of manufacturing in India are clothing and footwear.
Yeah, and you can see the vibe when you go to a mall and when you look at the kind of branding. You try and buy a branded t-shirt, the prices are moving up.
Yes, so the malls are, of course, for the middle class. If you go down into the really suburban and not suburban really, I mean the tier 4 towns and the rural
sub-Saharan part, like you like to call it.
In terms of productivity, they are. So if you go there and you find that all male attire is pre-stitched, you find that packaged foods are selling, right? That everyone wears shoes. Right, so as I think Shekhar Gupta mentioned in one of his articles when he was doing his election, writings on the wall, he said, even in Bihar, everyone is wearing shoes. It's a huge sign of change. I mean, it's shameful that 60, 70 years after independence, we are still happy the people wearing shoes. But the fact is, they were not wearing shoes 10 years back, and now they are, right?
Lovely to have you, and thank you for sharing those lovely data points. It's been lovely walking with you in this wonderful place. Sometimes it's hard to understand that Bombay also has some of these lovely places.
And so close to our office.
Yes. That's it on this edition of Market Makers. Thank you for watching the show. Thank you for tuning in.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.